Now we are going to see the amendments for assessment year 1920. First, slab rates and surcharge remain unchanged. So what has changed is education cess. Previously education cess was 3%, now it is 4%. So whether the same name education cess is being retained? No. Instead of education cess, a new levy called health and education cess is being levied. So what is the rate? 4%. So essentially there is an increase in the rate of tax. So the rate is 4% from the existing 3%. So basic tax plus surcharge is applicable minus rebate as usual, which is necessary for the tax calculation. Now with regard to taxation, so with regard to capital gains, we are going to see one important amendment. So with effective from assessment year 1920, long-term capital gain on sale of equity shares, units of equity-oriented mutual fund, units of business trust, or on a stock exchange which were earlier exempt under section 1038 but now become taxable under 10% under newly introduced section 112A shall be ineligible for the benefit of taxation. Now the long-term capital gain, that is LTCG, on sale of three important things. What are they? Equity shares, equity-oriented mutual fund, then units of business trust on a stock exchange. So these three things are only aided by this section. So the equity shares, sale of equity shares, equity-oriented mutual fund, and units of business trust on a stock exchange. Is long-term capital gain or short-term capital gain? It is only long-term capital gain which is being covered here. Now, earlier they were exempt under section 1038, but now it is getting taxable. So earlier it was exempt, now it is getting taxable under long-term capital gain. What is the rate? 10%. So the rate has become 10% under newly introduced section 112A. Now, if it is long-term capital gain, what is the important point? Indexation benefit is there. But here, under this long-term capital gain, these three things, even if it is attracting under long-term capital gain also, it shall be ineligible for the benefit of taxation. So that is what being explained here. Section 112A, long-term tax on long-term capital gain on stock market sale with effective 1920. Under the existing regime, long-term capital gains arising from transfer of long-term capital asset. What are they? Equity shares in the company, or unit of equity oriented fund, or unit of business trust. Earlier it was exempt under section now 1038. Now it is coming to taxable under section 112A. Why? Because the government felt that because if it is giving exemption under section 1038, it is causing a lot of tax revenue loss to the government. That is why, in order to minimize economic distortion and curb erosion of tax base, the government is feeling that there is a potentiality of taxing more and more people under this section. Therefore, the government has withdrawn exemption here. So, it is proposed to withdraw the exemption under class 13 of section 10 and introduce new section 112A. Taxability is 10%. So, long-term capital gain shall be taxed 10% on capital gain exceeding 1 lakh rupees. What is the threshold? Beyond 1 lakh rupees, the taxable rate will be 10%. Now, the concession rate will be applicable to the long-term capital gain. What are they? We already know that equity share in company, security transaction tax has been paid on both acquisition and transfer of the capital asset. So there are three possibilities. One is that, first one is the sale of equity shares. So what is the condition for the equity shares? You have to pay STT, security transaction tax, both at the time of acquisition and even at the time of transfer of such asset. Now, in case of long-term capital asset in the unit of an equity-oriented fund or unit of a business trust, STT has been paid on transfer of the capital asset. So these two, the security transaction tax must be paid. Now, it empowers the central government to specify by notification the nature of acquisition respect of the government of requirement of payment of security transaction tax shall not apply in the case of equity share in a company. Now, the requirement of payment of STT at the time of transfer of long-term capital asset, being an equity share or a unit of equity-oriented fund or unit of mutual business trust, shall not apply if the transfer is undertaken on a recognized stock exchange located in any international financial service center and the consideration is received in foreign currency. So, the government has said what are the exceptions to that. So what are the exceptions to that? The government can specify by specific notification that such and such class of share need not pay security transaction tax. Similarly, requirement of STT can be being an equity share of a unit of equity oriented fund or unit of businesses shall not apply if the transfer is undertaken recognized stock exchange where located in any international financial service center and consideration should be received or receivable in foreign currency, not in INR. Now, the new provision shall propose to provide the following. This is a summary. Long-term capital gain will be computed without giving effect to the first and second provision of section 38, that is indexation benefit is not given. What is the indexation is given? Normally it is given in respect of cost of acquisition, cost of improvement, if any, and the benefit of computation of capital gain in the case of non-resident will not be allowed. So the point is that indexation benefit in the case of cost of acquisition and indexation benefit in the case of cost of improvement, both are not given to this particular 112A calculation, and this is not allowed. Now, special rates of tax. So there are some rates of tax has been tweaked. So first is with the effect from 1920 under section 115A. So this is with regard to non-resident taxation. So royalty or FTS received by a non-resident or foreign company. So the royalty or FTS. So both are being governed by the 115A. Now, who can receive it? Either it can be received by an individual non-resident or it could be by a corporate, foreign company. So, two categories of person, that is non-resident or a foreign company. From the National Technical Research Organization shall be exempt. So, what is the nature of payment? It could be royalty or FTS. Who is receiving it? Non-resident or foreign company. From whom? From National Technical Research Organization. If all these conditions are being satisfied, then exemption. Now, assessment in 1920 as deemed dividend under section 222E. We know dividends are being covered from section under section 222, especially deemed dividend under section 222E. We also know that it is a very draconian section. It is not actual dividend, but it is deemed dividend. Now, shall also suffer DDT, dividend distribution tax under section 115O. Non-residents will no longer pay tax on the same under section 115A. So, because deemed dividend is suffering DDT, already suffering taxation under 115O, non-residents will not be paying tax on the same deemed dividend under section 115A. As the rate of DDT is 30%, it shall be fully exempt for the shareholders under section 1034, and the provisions of 115 BBDA shall not be attracted on the same. This is with regard to deemed dividend. Now, 115AC, transfer of bonds of GDR, rupee denominated bonds of an Indian company. It should be the bonds of the Indian company. It should not be denominated in foreign currency but in rupee denomination only. Or denominated is made by a non-resident or on a recognized stock exchange located in any international financial service center. It should be a recognized stock exchange and it could be located in any international financial center. Now, consideration. How is the consideration being paid? It is paid or payable in foreign currency is excluded from the definition of transfer. It is not paid in Indian currency. It is being paid in the foreign currency. Now, what is the rate of tax? Rate of tax shall be 60% plus surcharge plus the new rate of tax. It is 40%, 4%. Therefore, the effective rate is 78%. Now, with the effect from 1920 under section 115A, tax on long-term capital gain for FIAs, foreign institutional investors shall be subject to the provisions of newly introduced section 112A. We have already seen it. Now, dividend distribution tax, DDT or buyback tax or income distribution tax. So, this is, we know that instead of 3%, it is 4%. DDT shall be attracted on deemed dividend under section 222E, that is 30%. There shall be no grossing upon the dividend. We know that while calculating the tax portion, we have to gross it up first and then only we have to do the calculation. However, there shall be no grossing up in this situation alone. Now, what is the surcharge? 12% and new cess is 4% shall be applicable. Further, as the rate of DDT is 30%, it shall be fully exempt for the shareholders under 1034 and provisions of 115 BBDA shall not be attracted. Now, income distribution tax shall also be payable by equity-oriented mutual fund at 10% subject to grossing up. Here, grossing up is being applicable. Surcharge 12% and higher education says it is 4% shall be applicable. Now, with regard to assessment of partnership firm, what is the rate of cess? 4%. Wherever the cess is being applicable for calculation, it is being revised from 3% to 4%. Now, long-term capital gain will be taxable under section 112 as well as 112A. Now, assessment of religious or charitable trust with effective from 1920 for the purpose of determining the amount of application under section 11, provisions of section 40A, subsection 1A, 48.3, 48.3 shall be applicable in the same manner as they are applicable to computation of income under PGBP. So, this 40A, subsection 1A, 48.3, 48.3A are all coming under the section PGBP. Now, when you are determining the amount of application, so amount of application we do it by calculating the assessment of trust. So, while doing the amount of application under section 11, what you have to do, the provisions of 40A, subsection 1A, 48.3 and 48.3 shall be applicable. You should apply it, which apply these three sections which are already governed under section governed by PGBP. Now, minimum material tax MAT. So as a retrospective amendment, this is not a prospective amendment, it is a retrospective amendment. That means from backdated it is being applicable. What is the date? With effective from 1/4/2001. For the removal of it is clarified that the provision of 115 JB shall not be applicable and shall be deemed never to have been applicable to an assessee being a foreign company where its total income comprises solely of profit and gains from business referred under section 44B, 44BB, 44BBA or section 44BBB, and income has been offered to tax the rate specified in those sections. So with regard to MAT, this is a retrospective amendment covering from 1/4/2001. So what they say, it is not being applicable for specified situations. So the assessee should be a foreign company. First point, the total income comprises solely of profit and gains, which means there should be no other income, only income under specified sections only. What are the specified sections? 44B, 44BB, 44BBA or 44BBB, and specifically the income which are derived should have been taxed under the respective sections. What are the respective sections? 44B, 44BB, 44BBA or 44BBB. Condition is that there should be no other income. Only the sole income should be only this income. So if that be the case, what has been told, 115 JB shall not be applicable.